Have you ever looked past the big headlines for a company and, really wondered what makes it tick, what's actually going on under the hood?
Right, beyond the numbers you see flashed everywhere.
Exactly. It's easy to get lost in all the jargon. So today we want to cut through some of that noise. This deep dive is for you, the curious listener who wants the real insights. We're diving into RTX's second quarter 2025 performance. And for this, we're using their latest earnings call transcript and the official press release.
Yeah, good sources gives us a solid foundation.
Definitely.
And our mission really is to pull out the most important bits, the key knowledge from these docs, give you a shortcut to being, well, properly informed about a huge player in aerospace and defense. And we're not just looking at what they reported, but digging into why it's significant and, what it hints at for the future.
Okay, so the big question for RTX this quarter was, could they keep up the momentum? They called it a dynamic operating environment, which sounds about right.
That's putting it mildly sometimes, yeah.
And the headline numbers, they look pretty strong. They definitely delivered what they called very solid results.
So what are we talking top line?
Sales climbed a strong 9% organically compared to last year. That hit $21.6 billion.
Okay.
Segment operating profit was also up 12%. And adjusted EPS, earnings per share, that came in at $1.56. That's an 11% jump.
Pretty healthy growth across the board then.
It looks that way. Now, there is a little nuance, especially if you're watching the cash flow closely.
Ah, yes, free cash flow.
Right. It was about break even for the quarter, technically an outflow of $72 million. But this wasn't a surprise.
No, they'd flagged this, mainly because of that work stoppage at Pratt Whitney back in May, right? For 4 weeks.
Exactly. That was the main thing. And the key takeaway here is they're really expecting a strong recovery on the cash flow front in the second half of the year.
Okay, that makes sense. And what's really striking, looking at the materials, is the demand. It's just, well, exceptionally strong for their products.
How do we see that?
Well, look at the Q2 book-to-bill ratio. It was 1.86.
1.86. Okay, unpack that for us. What does that number really tell you?
Right, think about it like this. For every dollar of stuff they shipped and billed in Q2, they booked almost $2 worth of new orders for the future.
Wow. So demand is really outpacing current sales.
Massively. It signals really strong future revenue, and that feeds directly into their backlog.
Which is now?
Staggering. $236 billion.
$236 billion.
Yeah, it's up 15% from last year and up 9% just since the last quarter.
That's huge growth. Can you break that down? Commercial versus defense.
Sure. It's about $144 billion on the commercial side and $92 billion in defense orders.
And these aren't just abstract numbers, right? There are some concrete wins driving this.
Absolutely. You see it clearly in the segment details.
Like at Pratt and Whitney.
Yeah, Pratt booked over 1,000 GTF engine orders. Think about that. Over 1,000.
That's incredible volume. Any specific airlines?
Big ones. Wizz Air, for example, up to 177 aircraft. And Frontier Airlines, 91 aircraft. These are airlines already using GTF and deciding to expand their fleets with it.
So real validation from customers. What about Raytheon?
Also very strong. Over $5 billion in integrated air and missile defense awards. And they specifically highlighted a $1.1 billion order for AIM-9X effectors.
AIM-9X, isn't that a Sidewinder missile variant?
That's the one. And they called this the largest order in the history of the program. Huge deal, benefiting the U.S. and international partners.
Okay, so the demand picture is clearly very robust.
Exceptionally. So let's dig into what's driving it, starting maybe with commercial aerospace.
That's good.
We're seeing really strong OE production. That's original equipment, new planes, basically. And the outlook for that production ramp up in the second half still looks positive.
What's underpinning that? Just airlines needing planes?
Partly, yeah. But it's also tied to global RPKs, revenue passenger kilometers. Basically how much people are flying. Those are expected to grow over 5% this year. And when people fly more, airlines keep their existing planes flying longer, so aircraft retirement levels stay low.
Which means more maintenance and upgrades for existing fleets.
Exactly. It fuels really strong aftermarket demand.
Yeah.
Take the V2500 engine fleet, for instance, a workhorse engine.
Uh-huh.
The retirement rate for aircraft using those engines is incredibly low this year, just 1% so far. That's telling.
And does that translate into the aftermarket numbers?
Directly. Overall, commercial aftermarket sales for RTX were up 16% in the quarter. Collins was up 13%, And Pratt Whitney aftermarket was up a really strong 19%.
Okay, so commercial aero is definitely firing on, well, maybe not all cylinders yet, but most of them.
Pretty much, yeah. The
What?
demand is certainly there.
All right, let's switch over to the defense side then. What's the story there?
The narrative here is a growing need for air dominance globally. And that's driving what they call unprecedented demand for their core defense products.
Unprecedented. What's feeding that? Geopolitics.
That's a huge part of it, certainly. But also specific policy actions, like the recent U.S. budget reconciliation legislation.
Right, I saw that included a lot of defense spending.
Over $150 billion additional defense spending, and crucially for RTX, about $50 billion of that is earmarked for something they call Golden Dome.
Golden Dome. Sounds intriguing. What is it?
It's basically code for integrated air and missile defense systems and munitions. Think Patriot, NASAMS, things like that.
Ah, so core areas for Raytheon.
Exactly. Core areas for RTX overall. So that funding is a massive tailwind. And then internationally, you've got the longer-term picture.
NATO spending.
Yeah, NATO allies agreeing to boost core defense spending to 3.5% of GDP over the next decade. And again, a specific focus on integrated air and missile defense.
So the demand signal is strong, both domestically and internationally. How is RTX positioning itself to capture that?
Through things like partnerships. For example, Raytheon just signed an industrial cooperation agreement with the Spanish Ministry of Defense that's specifically to help support Patriot missile production locally in Spain.
Okay, building local capacity to meet that rising demand. Makes sense.
And just briefly touching on the trade situation, tariffs and all that.
Always a factor.
It's been, let's say, fluid, but their outlook on the impact of tariffs seems to have improved.
How so?
Partly due to some positive news, like a UK agreement that exempts certain aerospace components. But also, they seem to be getting better at mitigating the impacts themselves.
Through things like
Optimizing how materials flow, qualifying parts differently, some pricing actions too. It's a combination. And that stronger performance plus better mitigation is why they raised their adjusted sales outlook for the year.
Got it. Okay, so beyond the numbers and market drivers, let's dive into their strategy. How are they actually executing?
Right, because having demand is one thing, meeting it is another.
Exactly. First up, executing on commitments. That Pratt Whitney GTF fleet management plan comes up a lot.
It's critical, and the key message here is that the financial and technical outlook for that plan remains consistent. They're sticking to the script.
Are we seeing progress on the ground? Any metrics?
Yes. Isothermal forging output, a key bottleneck part, was up 12% year over year and 10% just from Q1.
Okay, that's tangible improvement.
And that helped support a 22% year over year improvement in the output for PW1100 engine MRO maintenance, repair, and overhaul.
And that's despite the work stoppage in May.
Exactly, which is pretty impressive. They're still aiming for over 30% improvement in that MRO output for the full year.
And that's key to reducing AOGs, right? Aircraft on ground.
Precisely. Getting those planes fixed and flying again. That's the goal for the second half. And at Raytheon, they're really leaning on their operating system to ramp up production significantly.
On which programs?
Things like GEM-T, Coyote, AMRAAM. For GEM-T and Coyote, the output actually more than doubled year over year in the quarter.
Wow, that's a serious ramp.
It really is. Shows they're managing to scale up production where it's needed most.
Okay, execution seems to be a focus. What about innovation? Innovating for future growth.
Yeah, this is where things like autonomy and AI come in. It's clearly a big push across the company.
Any examples this quarter?
They announced a new partnership with Shield AI.
Shield AI. They do AI pilots for aircraft, right?
That's them. The partnership is about integrating AI-based sensor and target recognition into some Raytheon products, specifically loitering munitions and their multispectral targeting system, which is already battle-tested.
So making those systems smarter and faster?
Essentially, yeah, giving them better situational awareness and decision-making ability. Another one is Ghost Eye Radar.
Ghost Eye.
It's a collaboration with Kongsberg. They're co-developing parts for this new radar. It's designed to be smaller, offer 360-degree coverage, and track things like drones, cruise missiles, the tougher, newer threats.
And how does it relate to existing systems?
It builds directly on their NASAMS system.
Ah, the air defense system used in Ukraine and elsewhere.
Exactly. NASAMS already has 13 partner countries, over 1,000 intercepts logged recently.
Oh.
So GOSAI is leveraging that proven tech base.
Interesting. Okay, so they're executing, they're innovating. How do they leverage their sheer size, their breadth and scale?
Good question. One major way is through data and digital tools. They're rolling out a company-wide data analytics and AI platform.
Their digital backbone, I think they called it.
That's the term, yeah. The idea is to connect everything, enterprise systems, thousands of machines on the shop floor, millions of hours of product performance data.
To do what, ultimately?
Make operations more efficient, enable smarter, faster decisions. It's about leveraging the data they already have across the entire company.
Are we seeing results from that yet?
They gave one pretty compelling example from their Collins avionics business. Engineers there are using this platform and apparently reducing software development times by about 30%.
30%? That's significant.
It really is. Shows the potential efficiency gains when you connect the dots digitally across such a large organization.
But you mentioned challenges earlier. Surely rolling this out across all of RTX isn't simple.
Oh, absolutely not. Integrating new digital systems across diverse business units, legacy IT infrastructure, different cultures, it's a massive undertaking. Getting everyone trained and using it effectively is key.
So the Collins example is promising, but it's likely still early days for the full digital backbone vision.
I think that's fair to say. It's a journey, not a destination they've already reached.
Yeah.
But the early signs are positive. And tying into that, kind of reshaping the company, is the portfolio evolution.
Right, they've been selling off some businesses.
Yeah, they agreed to sell the Simmons Precision Products business from Collins for $765 million. And they completed the sale of their actuation business for $1.8 billion.
Why these specific businesses?
The stated goal is to focus the portfolio, right? Invest more in their core capabilities. And the cash proceeds obviously help strengthen the balance sheet.
Makes sense. And speaking of cash, the dividend.
They raised it again, an 8% increase this quarter.
Which
Confidence. Confidence in executing that huge backlog and generating strong cash flow over the long term. They're now expecting to return $37 billion to shareholders between the merger date and the end of 2025.
$37 billion. Okay, let's pivot back to the outlook for this year then. You mentioned they raised the sales guidance.
That's right.
Can you give us the new numbers?
Sure. Full-year adjusted sales are now expected in the range of $84.75 billion to $85.5 billion.
And that was up from
$83.0 billion to $84.0 billion previously. So, a decent bump.
And organically, what does that translate to?
It means they now expect 6-7% organic sales growth for the full year, up from their prior forecast of 4-6%. So definitely seeing some acceleration.
Any more detail on where that growth is coming from, like commercial versus defense?
Yeah, they broke it down. Commercial aftermarket is now expected to grow in the low teens. I think maybe 11-13%. That's up from around 10% before.
Okay.
Commercial OE, new equipment, expected to grow high single digits now, up from mid-single digits.
So both commercial channels revised upwards. And defense?
Defense is holding steady, still expected to grow mid-single digits for the year.
Got it. Now, you mentioned tariffs earlier and how the outlook there improved. Let's dig into that. It's a pretty significant topic.
It really is. It's been a major headwind they've been grappling with, so the update is quite important.
What's the new assessment?
They now estimate the net cost of tariffs for 2025, after their mitigation efforts, will be around $500 million.
$500 million. And that's down from what figure previously?
Their initial outlook was $850 million.
Yeah.
So that's a $350 million improvement. It's quite substantial.
Wow. Yeah. How much of that $500 million have they already felt?
About $125 million was incurred in the first half of the year, so the bulk of it hits in the second half.
And there's a cash impact too, right? Slightly different.
Yes, the associated cash impact for the full year is expected to be around $600 million.
Okay. What specific things are they doing to achieve that $350 million mitigation?
It's a range of things. They mentioned expanding coverage under the USMCA trade agreement, getting more parts qualified for military duty-free exemptions, taking maximum use of free trade zones, optimizing how they move materials around, and also using pricing actions where possible. It's a multi-pronged effort.
And this $500 million figure, does that assume tariffs stay where they are now? What if they go up?
Good question. They clarified that the $500 million contemplates the rates currently in effect. However, they also expressed confidence that they could absorb potential future increases, mainly citing the underlying strength they're seeing in their markets.
Okay, so some resilience built in there potentially. Now, aside from tariffs, there was also news on tax legislation.
Yes, some positive developments there too.
What was the main impact?
The big one is the restoration of full expensing for R&D costs, research and development. That's a significant benefit for a company that invests heavily in innovation.
Right, they don't have to amortize it over several years anymore.
Exactly. Plus, they noted stability in the corporate tax rate, which they expect to be around 19.5% for the full year.
And what does this mean in terms of cash?
They said it's expected to provide a moderate cash benefit this year. Not huge, but helpful in offsetting some of that tariff headwind.
And it continues beyond this year.
Yes, they specifically mentioned it will continue to be a benefit in 2026, 2027, and 2028 as well. So, a nice little recurring tailwind.
Okay, so tariffs are less bad, taxes are a bit better. How does this all net out for the bottom line, the adjusted EPS outlook?
Right. This is where it gets interesting. Despite the improved tariff picture, they actually lowered the adjusted EPS range slightly.
Oh, why is that?
The new range is $5.80 to $5.95 per share. That's down from $6 to $6.15 previously.
Okay.
They attributed this primarily to that remaining $500 million tariff headwind, which translates to about a $1.30 impact on EPS.
Ah, so even the improved tariff number is still a significant drag on earnings.
Exactly. Now, that $1.30 drag is partially offset by about $1.10 from better-than-expected operating performance.
Where's that coming from?
Mainly profit growth at Raytheon and better volume drop-through at both Pratt and Collins. So operations are slightly ahead, but not enough to fully offset the tariff impact on EPS.
Got it. But despite that EPS adjustment, what about the free cash flow outlook? Did that change?
No, and this is key. They reiterated strong confidence in the full-year free cash flow outlook of $7.0 billion to $7.5 billion.
So earnings slightly down, but cash flow guidance remains intact. What drives the cash in the second half?
Two main things: underlying segment profit growth and significant working capital improvements. A big piece of that working capital swing is the recovery from the Pratt work stoppage.
How much cash does that Pratt recovery represent?
They expect it to contribute around $1 billion just in Q3 alone as things normalize.
Okay, that's a major driver.
Absolutely. And looking beyond this year, they painted a picture of really strong underlying cash generation. Operational free cash flow, which excludes costs related to the powder metal issue, is running well over 100% of adjusted net income.
Which is a healthy sign.
Very healthy. It points to the fundamental cash-generating power of the business, driven by OE growth, continued aftermarket strength, and that massive defense backlog.
Right, that's a really helpful breakdown of the overall financial picture and outlook. Should we take a quick run through the individual segments, see how they performed?
Yeah, let's do that, starting with Collins Aerospace.
Okay, Collins, Q2 sales. $7.6 billion, up 9% organically, looks solid.
Yeah, and the commercial aftermarket was the star there, up 13% overall.
Any particular strength within aftermarket?
Mods and upgrades were up a huge 20%, parts and repair up 12%, provisioning up 9%, so broad strength.
And defense for Collins.
Also strong, up 11%. Driven by F-35 work and the Survivable Airborne Operations Center program, commercial OU is just up 1%, kind of muted by lower 737NX volumes, though 787 was higher.
Okay. And profit for Collins.
Adjusted operating profit was up 9% to $1.25 billion. Margins held pretty steady.
What about the outlook for Collins for the full year?
Sales outlook actually improved slightly, now expected to grow high single digits organically. But the operating profit growth outlook was revised down.
Down? Why?
Now expected between $275 million and $350 million growth, down from $600 million to $4. And the main reason cited: expected tariff impact hitting Collins.
Ah, okay. So tariffs are definitely biting into Collins's profit outlook. Any big opportunities for them?
FAA modernization seems like a key one. That reconciliation bill has $12.5 billion for overhauling the air traffic system.
And Collins plays heavily in that space.
Big time. Radars, automation systems, aircraft equipage, they have strong market share. Plus, internally, they mentioned a significant transformation underway at Collins.
You mean what?
Right-sizing the business, streamlining the back office, optimizing their physical footprint, and increasing automation, trying to become more efficient.
Okay, lots happening at Collins. Let's move to Pratt Whitney.
All right, Pratt. Q2 sales, also $7.6 billion, but up 12% organically. And remember, that's despite the 4-week work stoppage.
Pretty resilient performance then.
Very. Commercial aftermarket led the way, up 19%. Commercial OE up 15%. Military sales were flat, though. Adjusted operating profit up 13% to $608 million.
And the outlook for Pratt. Similar story to Collins.
Sales outlook revised up, now expected to grow low double digits for the year, better than high single digits before. But yes, operating profit growth revised down.
Due to tariffs again?
Primarily, yes.
Yeah.
Now expecting $200 million to $275 million profit growth, down from $325, $400 million.
Okay. What's the latest on the GTF fleet management plan? You mentioned MRO output was up to 22% despite the strike.
Yeah, that was a key data point. They emphasized that AOG's aircraft on ground have stabilized down.
Stabilized but not yet improving.
Stabilized in Q2, but they expect them to come down meaningfully in the second half of the year.
Driven by
Continued growth in that MRO output, plus improving turnaround times for engines actually in the shop. They're getting faster at the repairs.
What about the older V2500 engine? Still important.
Absolutely. Still seeing strong demand. They forecast 800 shop visits for V2500s this year and expect the revenue content per visit to actually go up longer term.
Interesting. And the new GTF Advantage engine?
Production has started. First deliveries planned for late 2025. And they highlighted the Hot Section Plus package.
What's that?
It's a set of 35 upgraded parts for the hottest part of the engine. Represents about 90% of the planned durability improvements. That package starts going into engines during MRO visits next year.
And the benefit?
Expected to deliver a significant time on wing benefit. Basically keep engines flying much longer between shop visits. They plan to seek value for that investment, meaning potentially higher service agreement pricing down the line.
Makes sense. What about Pratt's overall margins?
They noted GTF margins are positive and double-digit now, and they expect Pratt's overall margins to expand sequentially, becoming a, quote, low to mid-teens business in the medium term, driven by aftermarket growth and their profitable military and Pratt Canada units.
Any one-off items at Pratt?
Just briefly, they mentioned about a $100 million charge related to a customer bankruptcy. They expect long-term recovery on that, but it was a hit in the quarter.
Okay, understood. Let's wrap up the segments with Raytheon.
All right, Raytheon.
Q2 sales were $7.0 billion, up 6% organically.
Yeah, driven by higher volumes in land and air defense systems, things like International Patriot, NASAMS, and also naval programs like the SPY-6 radar and Evolved Sea Sparrow missile.
Profitability at Raytheon?
Strong. Adjusted operating profit up 14% to $809 million. Margins expanded nicely.
And bookings, you mentioned strong defense demand earlier.
Very strong bookings in Q2. $9.4 billion. That's a book-to-bill of 1.35 for the quarter.
Pushing the backlog higher?
Yep. Backlog now at $63.5 billion. And their rolling 12-month book-to-bill is even higher at 1.49. So orders consistently outpacing sales.
What's the full-year outlook for Raytheon?
Sales outlook remains the same. Low single digits adjusted, mid-single digits organic growth. But the operating profit growth outlook was actually increased.
Increased, unlike Collins and Pratt.
Right. It's now expected between $225 million and $300 million growth, up from $150, $225 million before.
Why the increase?
They cited a favorable mix of international programs, so better margins on the work they're doing.
And looking beyond this year for Raytheon?
The demand profile looks incredibly strong. That backlog is up about 25% just since the end of 2023. Huge growth, especially in core areas like integrated air and missile defense and sensors, demand coming from Europe, the Middle East, Asia-Pacific.
And that U.S. budget funding, the Golden Dome stuff.
Yeah, that $25 billion for integrated air defense and $25 billion for effectors aligns perfectly with Raytheon's sweet spot. Patriot, NASAMS, Coyote counter-drone systems, TPE-2 radar, SM-3 missiles, they're right in the middle of it.
Are they investing to meet that demand?
Yes, about $250 million this year alone in expanding capacity places like Tucson, McKinney, Camden, plus putting more people into their supply chain to help suppliers keep up. And it seems to be working. They noted this was the 9th straight quarter of material growth flowing into Raytheon.
9 quarters, that's consistent progress. Anything else significant for Raytheon? LTMDS.
Yeah, the lower tier air and missile defense sensor, LTMDS. Big program. They achieved milestone C, which basically green-lights the production phase. They've already delivered 6 units to the U.S. government.
And the significance there?
It's seen as the future radar for Patriot, potentially. Yeah. And given there are 19 Patriot partner nations out there, the integration potential and export market could be huge.
Okay, that covers the segments in detail. Before we wrap up, you touched on supply chain earlier. Maybe circle back to that. It feels like an unsung hero or potential villain in all this.
That's a great way to put it. It's absolutely crucial. And the overall message from RTX is one of improvement across the company.
Any specific examples?
Yeah, they gave a few. At Pratt Whitney, structural castings availability is up over 20%. That's been a major choke point.
Because that's good news.
At Raytheon, as we just mentioned, 9 straight quarters of material growth coming in. And at Collins, they've managed to reduce the number of overdue line items from suppliers by about 25%, just in the first half of this year.
So tangible progress across the board. What are they attributing that to? Just hard work?
Partly, but they also credit their core operating system. It sounds like it's fostering better collaboration with suppliers, understanding demand signals better, making changes to improve producibility, things like that to increase throughput.
But it's not perfect yet.
No. They were clear to acknowledge there's still more to do, especially as production rates continue to ramp up. It's an ongoing challenge, but the trend seems positive.
All right, so after diving through all of that, hopefully we've given you, our listener, a much clearer picture of what's really going on at RTX, beyond just the headlines.
Yeah, it's clear they navigated Q2 well, delivered strong results overall.
Definitely. You should have a comprehensive understanding now of that performance, the strategic moves they're making with innovation and the portfolio, and how they see the rest of the year shaping up, including those tariff and tax impacts. Feels like they have significant momentum.
They certainly do. Which leads to maybe a final thought to leave you with. Given RTX's really aggressive investments in AI and autonomy, and that clear focus on integrated defense systems we talked about,
Yep.
how do you think their long-term growth might actually reshape the global landscape? Not just defense, but commercial aviation too, over the next, say, decade.
That's a big question. Definitely something to mull over. We hope this deep dive has armed you with the insights to think critically about it. Keep exploring, keep questioning, and keep learning. Thanks for joining us.